whether it's meme stocks, cryptocurrencies, or something as simple as having and managing their own investment wallets. We know that Gen Z and millennial investors are shaping the way that we think of finance. They consume information in a different way. In many cases, they opt out of a pension, and they no longer rely solely on their brokers to make investment decisions. But how has that changed the way our industry professionals do business, the way they communicate, and the role technology has played in all of it? And this is what we're going to talk about here. So if we look back at the past 10 years, I wanted to know how your job has changed on a day-to-day. What have you done differently? What do millennials and Gen Z want? How does that change the way you think about your job and how technology has played a role? Maybe we can start with Mel, or?
Sure, and thanks so much. I'm so excited to be here. I think one of the main things that we've seen in terms of how my job has changed is really understanding the mindset of the investor. So gone are the days where someone would just sort of let you run with a portfolio and turnkey. So we're seeing investors that really want to be more engaged as part of the investment choices that they make. We're seeing investors who want to be educated alongside you as you are implementing solutions on their behalf. And I think one of the other things that we've seen is the advent of technology. And I just think of meme stocks, which my nieces were a part of, where they're calling me up, and my brother called me and said, what is happening in their accounts, thinking that they had done something wrong, but instead they had been following on discussion forums and really coalescing that sort of community power and all driving towards one investment. So what you see is the advent of technology really changing how people are gathering information and executing.
Shawn?
I think the biggest thing we've seen is just how we interact with our clients, and also technology has enabled us to have, I think, a lot more just diverse discussions with them. So it can be on education, it can be on retirement planning, it can involve quite a few different products, and also the mediums that we're interacting with them. Right now, the growth in mobile is something that has been incredible over the past 10 years, where we went from low single digits of our client trading activity and logins coming in mobile, and now on some days it's over half. And when you think of research tools, charts, trading capabilities, whatever that might be, when you're going from a desktop platform with the power of an actual computer behind it to now it's limited by what's on your phone bandwidth, it was almost impossible to think of having some of the tools that we have at clients' fingertips now available. If you would have told me some of the features we have, not just in our platforms, but even in our competitors, it said that was going to be there back in 2012, 2013, I would have had a significant amount of doubt. And the other thing is clients coming in, and you think of clients, the level of sophistication they're coming in with. There used to be a pretty predictable continuum. You come in because you're interested in buying a single stock or you're interested in an ETF, and then you slowly over the years might become more comfortable doing something like a covered call or a buy right strategy. That was pretty standard, and we can plan for that pathway as they explore more advanced products. And now clients are coming in and they want to go right into options. They want to get right into trading. And for us, the challenge is how we make sure they come on board, they can participate in the way they want to, but we try and get successful outcomes, more sustainable clients. That's something that was already evolving. And then when you think of what happened with the pandemic in 2020, like so many other businesses, it jumped us 5 years into the future, I think, in terms of just the sheer amount of clients that were coming on board. So for us, the challenge coming out now is keeping them engaged as the momentum trades of just go out there, buy calls, ride the market higher. That really isn't a phenomenon anymore, but we're seeing them remain engaged. And for us, it's more continuing with education and I think getting them to think more holistically about their financial situation.
Angela?
Well, as a CIO of a public pension plan, my day-to-day job has not really changed. I'm still a strategic investor. I still have a long-term horizon. What has changed is the way we implement our strategies, we implement our policies. the fact that we have so much data to research and the way we source our data and the tools that we use. And I think these changes have been driven by really just a need for more technology solutions to really analyze the data that we're trying to absorb. And also the acceleration of technology, brought on by COVID that we've all experienced. And lastly, the need for technology because of the macroeconomic changes and challenges that we're facing today. Excel, spreadsheets, and Word documents really don't work for the millennials that I manage, so we've had to really transition to more software technology to really synthesize that data and transform it into usable information that we can use to make decisions. From a different aspect, when we think about the members that will service in the future, those millennials, those Gen Zs, even those that alpha generation, they are no longer going to want to pick up a phone and call the pension plan. They're no longer going to want to meet with someone in person. So we have to think about how do we restructure, how do we rethink public pension plans so that we can service them into the future. We think about self-service, technology, virtual meetings, electronic documents, and I think right now we're all, like many pension plans, are modernizing their solutions and their technology to kind of meet those needs down the road.
And Angela, talk us through the interest in pension plans. You know that a lot of young investors maybe aren't as attracted to pension plans. They want to manage their own wallets. They want to invest in riskier assets. What's your experience been?
Well, managing a younger generation and also having two Gen Zs at home, I think back to the baby boomers and the way they saved, the way they invested, whether it was, savings, government savings bonds, whether they were part of, a pension, part of an employer stock purchase program. All of these things are unfamiliar to the new investor. And so, they had benefits, and they were generous benefits, and they took advantage of everything that their employers had to offer. And normally they stayed with a company for 25 plus years. And now if we fast forward to today, pension benefits are not what they used to be. It requires the new investor to really look at the stock market and different ways to invest. And thinking about a public pension plan is like an afterthought to them because there's more years that they have to be vested. The benefits are lessened, and you have to work more years than they even could fathom staying with an employer. So it's really, on the back burner, it is a benefit, of course, but secondary to them wanting larger salaries and being able to invest personally and aggressively in the stock market at a faster pace. And so I'm seeing more of that, and it's just kind of a move away. Corporate pensions have kind of gone away, so it is something that they think is great because their parents have pensions and they no longer have to think about how to secure income to take care of that generation. But the way they're investing is much different than how other generations have invested.
Right, and we talked a little bit about communications and the way we communicate. Is more information equals to better information? Is it really helping the generation make these decisions? And Shawn, there's a question from you from the audience wanting to know whether you have restrictions and what's your guidelines for communicating via mobile.
No, if you think about it, if we send you an email, electronic communication, and you check it on your phone, technically that's considered a mobile communication. We try and utilize almost any channel that we can in communicating with clients, and that's not just for any sort of legal communications, but clients can access service. We invest quite a bit in our service capabilities, and we don't want the only way you can interact with our service to be by picking up the phone. We want you to be able to chat in on your mobile or whatever that might be. And that's also something that is an interesting turn where we actually see a lot of our more sophisticated clients comfortable going through mobile, but you've got to make sure they don't get the sense there was some bot that's just giving you canned answers. I think that's something that's an interesting development as well, because it used to be if you had 1 million clients, you had to have enough people on the phone on a busy day to pick that up. Being able to do things through chat and other channels certainly helps. And I think it's not just support that we're thinking of or delivery of legal documents, but also education now. We've invested quite a bit in education as well, to be able to have our clients learn, become more informed investors through any medium they want.
And Mel, is more information better information, or are they making better decisions? What are your experience?
Not necessarily. I think it depends on the source. I mean, finance TikTok has become all of the rage, and having been on there and seen some of the advice, definitely source of information is something that people should take into account. So I don't necessarily think more information is better, but I also think that attention spans are getting shorter. So gone are the days that you could do sort of an hour-long session. People are looking for information in snippets, and so that's changed the way that we've rolled out communications. Like, we're giving highlights in no longer than a minute or two, and really giving people the takeaways and allowing them to have a journey through the information in a way that suits them. So we're finding that, although finance TikTok, be that what it may, there's some great advice on there, there's some not so great advice on there, but we are really looking at exploring some of those mediums and seeing if those are areas that we want to take a look at.
And when you think about that, is financial advice dead?
I don't think so. I think that the old method of delivering it is waning. Where you would make an appointment and you would go see someone. I think what we're finding now and what the pandemic has really accelerated for us is that people are quite comfortable meeting with advisors over Zoom. People are quite comfortable getting messages sent to them through mobile. That is all something, and people are quite comfortable in entering a Clubhouse chat and having a conversation with advisors. All of the mediums are on the table.
Right. If I could bring this conversation a little bit back to what's going on right now, what we're reading in the news, we're looking at, a war in Ukraine, and a lot of these investors have never seen a boots on the ground war. They've never seen inflation this high. And remember, last time inflation was this high was 40 years ago. So a lot of these young investors weren't even alive for it. When you think about that, how they've also never seen a Fed that's been this aggressive with monetary policy. How has that affected their decision making? They were all into meme stocks and crypto. Are they getting more conservative now?
Yeah, I think I'll take that. I think what you're seeing is a lot of millennial investors start turning into longer term investors. What we've seen up until recently, a lot of folks have been chasing short term gains. And what all of the advent of these, whether it's US-China tensions or the war in Ukraine or a lot of the monetary policy decisions, is that it forces younger investors to start looking at that longer term horizon. And I think that, and I can talk a little bit later about how we see the advent of sustainability kind of come back to the forefront when that happens.
Shawn?
Yeah, I think one thing that's been really interesting just in terms of client interaction. So one, when we look at some of the moderation in trading activity, the biggest drop, if you look at it from groups, it's people that opened their accounts in 2020 or 2021. Now, they're not trading as actively, but they're not disengaging. They're not saying, I'm pulling my money out and going elsewhere, wherever that might be. They're doing exactly what you said. They're starting to think more holistically around the macro environment. Some of them are still sitting on some good profits that they did make over the 2020, 2021 period. And they're now looking for, I think, a little bit more of a longer term investment. Another thing we're seeing is a lot of activity moving away from single stock type names, and they're going in towards exchange traded products, things that tie in a lot more to the macro themes that they're seeing. And I think inflation's a great example because you actually I think traditionally you would think, I think crude oil is going higher, I'm going to buy ExxonMobil or one of the energy companies. But what product development proliferation has done is there's actually a lot of products of, if you want to do something where you are now have upside exposure to crude oil, there is something where you can get that direct exposure. You don't have to try and go through Exxon and hope they don't have a fire or an outage or an oil spill. That's a huge, I think, difference that we've seen, and that has actually really taken shape over the past year, and you see it show up in volumes across the industry. So I don't think it's just our clients. I think it's retail investors across the board are starting to shift from single name stocks into more of those vehicles they can play macro themes on.
Yeah, I think over the last 3 years, there has been a transition for younger investors, as well for those of us who haven't been in the industry for 30, 40 years. The inflation is new, and we're thinking about it differently. We knew at some point, that there was going to be market corrections, there was going to be volatility, there was going to be inflation. It took us 3 years to kind of round that corner and actually see it. And now, one of the biggest challenges for a large institution like IMRF is that, the breakdown of diversification benefits between stocks and bonds. And that has been something that has driven our decisions, as well as younger investors. No matter the generation, we all knew that we had to rebalance our asset allocation. We had to rebalance. We had to look beyond stocks, to look at other strategies to really meet our investment objectives. And so that's been really a part of it. Younger investors just have come along. They understand that this is a way that public pension plans invest. They are thinking more long term. They are thinking about investing, spending, and debt differently than they were before.
And there's no way we could not talk about FTX here, right? So we're talking about young investors. We need to talk crypto. After the collapse of FTX, are you seeing their attitudes towards crypto change? And can you talk a little bit about what's your organization approach to crypto? Can you touch it? Can you not? And when you think about, I'll bring in a question from the audience here too. They're asking about what's the mentality between wanting that short-term gain that we've seen, in assets like crypto?
Well, we've been open to educating ourselves more about cryptocurrency and blockchain. But, as a public pension plan, we do not invest in cryptocurrency directly. We do have some venture capital managers that have some limited exposure to it. There was some exposure to FTX and others, but very limited. We would definitely not invest in a manager that solely invests in cryptocurrency. Now the millennials on staff definitely interested in crypto, definitely interested in blockchain, and we've tried to educate ourselves around how it's not a good fit. Normally, we don't invest in anything that we don't have a grasp, understanding of, or that is not regulated. And that's a part of most pension funds investments. There has to be regulation. And so I think that, it is an industry that's going to be around because there's going to be a demand for it. I don't think that millennials have turned their backs on it, but they're definitely, after FTX, asking important questions around due diligence, around really regulations, and how do they protect their money.
Shawn?
Yeah, I think if you think about the big thing with FTX, it wasn't necessarily the crash in the value of crypto, which when you're investing in something, that's usually the very front of your mind is this going to go up or is it going to go to zero? You had already seen Bitcoin correct from 60,000 down to 20,000, in some cases a little bit lower, and that occurred over the past year. The problem with FTX was a little bit more of transparency that you get in our markets. You don't get that if it's a company in the Bahamas. You don't know what the rules of the game are that they're playing by. It makes it a lot more difficult. And I think for a lesson learned. I think if you just want to say, luckily, this wasn't something widespread, so it wasn't able to become systemic and really take down the financial system in any meaningful way. But if you think about it, if we had mandates from pension funds where they were putting mandated in their investment policy statements to put money in there, you could have had crypto spread around the financial system and people could have been in some trouble. So I think moving forward, and what I think this does mean for the crypto space is there's going to be almost an institutional due diligence mentality out of individual investors now. They're gonna, if you are gonna go out there and try and market crypto, offer crypto, you better have a pretty deep FAQ behind it and be ready to answer some very pointed questions. And I think that would be a good sign to hear coming from individual investors. It's just about what can go up tomorrow. They're thinking more holistically around just the general safety of their investments.
And Mel, what are your thoughts? Is crypto dead?
Oh, absolutely not. But I think to what the other panelists have shared, I think that there's been a sobering effect with what's happened with FTX. And I think to your original question, which was why millennial investors have been so short-term focused. I mean, when you think about it, right, look at what's happened with the S&P 500 since 2008, right? It's been up 262%. These investors have never known a down market. Things only go up, really fueled by the advent and the quick turnarounds we've seen in tech stocks, where you've had just enormous pops in valuation in short periods of time. So that, it sort of has been encouraging that short range focus and that short range mentality. But, you know, those things tend to be waning. I mean, I think US stocks right now are underperforming the rest of the world by 2%. So I think it's forcing that reckoning that eventually happens where people are starting to slow down and take a look at it more long term.
And if we can, you know, get your crystal balls out, look into the future, what trends are we seeing now that you expect to persist? Mel?
Well, I think in terms of, I think AI is one of the trends that I see that will persist, not only on the financial industry side, where they're using AI right now to really cause more efficiencies, even in how they're onboarding clients and how they're processing lending applications and whatnot, but also on the investor side. Right, AI is super efficient in the fact that it takes the emotion out of decisions. It's going to be much better than an individual at that. The downside risk, though, is that it's only as good as the data that you put in it. And so I think you'll start to see more happen in the AI space and even beyond the use of robo-advisor and robo-advising platforms. But I think what you see is millennial investors have said, and we've surveyed them, they like the transparency that AI offers when making investment decisions. And so you'll see more of that in the coming years, I believe.
Shawn?
I think from an investor standpoint, there is going to be a lot more of a holistic focus on the ecosystem around any theme. And so I think electric vehicles is probably a good one. And that is people aren't just trying to find the next company that's got the coolest car, the coolest gadgets or the longest distance. They're actually really starting to think more holistically around, oh, well, they're going to need chips. So I start looking at semiconductors. These batteries use a lot of rare materials. How do I find out what those materials are? And then how maybe do I invest in that huge build in demand that's not just coming from Tesla, now it's coming from GM, Ford, Volvo, all the major car companies. They understand that now. And I think the challenge is going to be, how do you invest in those? Because I think if you ask someone, how would you go invest in platinum or palladium or whatever that might be right now, they wouldn't really have a quick, direct answer. They probably have to do a little bit of searching. But I do think it's not going to be just focused on the front end, coolest tech. It is going to be, I think, a little bit more of a balancing act between actual physical commodity investment and then still having some exposure to those front end platforms and services that they're going to be offered. So I think it'll be more diversified than just let's pile into every up and coming tech company we can.
So I think we talked a lot, you know, about factors that involve ESG. Angela, maybe you can talk a little bit about how you're incorporating ESG into your business and how important it is for young investors.
We've really taken ESG and really implemented it into our processes. We look at ESG more as a tool, an evaluation tool of the asset managers that we hire, to really understand where they can mitigate risk and create value in their strategies. So it is a part of our processes. It runs through every asset class. We ask those questions of every manager, and it allows us to really take a deeper look into how the environment, how social and how governance really can drive a strategy. We focused more on the S here in Illinois because we do encourage DEI, diversity, equity, and inclusion. We look across managers and we try to encourage access to capital for minorities and women-owned firms. So we spend a lot of time on that S part of ESG.
And how are you looking into, greenwashing, and how do you avoid that? What sort of precautions are you taking, and what do you see as the future of ESG with a lot of states now trying to ban ESG investing? Maybe Mel, you can take that one.
Yeah, so I think that what's happening now is sort of the emphasis on reporting, right? You used to be able to get away with sort of a vague promise and then some sort of environmental commitment, but gone are those days. And especially now that the accounting firms have really standardized how companies are being able to report on their ESG standards. So I think you're going to see much more emphasis on the data piece of it. And it's important because when we look at what investors are looking for, millennials are the one population that is really doubling down on the sustainability commitment. What our studies show is that 6 in 10 of them are involved in sustainability through their across the board, personal consumption, philanthropy, and their portfolios. And 40% of those millennials have a 50% allocation or higher to ESG integrated products. So it's incredibly important for us. And I think the future of ESG is going to really sort of move along those lines and taking a more holistic approach, not only looking at reporting, but really demanding that CEO pay potentially be linked to some of these ESG standards, really taking a look at something we call inclusive investing, which is what Angela talked about. How can you change the ecosystem of how capital flows throughout the system by putting it in the hands of more diverse capital allocators? That's something that we're seeing more and more appeal to millennials. And so I think that they're going to be looking for measurement around those commitments in an attempt to avoid greenwashing.
And if we think about technology and the next 10 years, what technologies you see prevailing, which ones you see maybe coming up that will shape the world of finance? Shawn, you want to take that one?
I certainly think the move to mobile, that is something that will continue, and the big driver behind that will be the capabilities of what we can actually put in there from a feature standpoint. And it's going to have to be, I think, a lot more rich. It's not just the next coolest trading feature. People are going to want to holistically be able to manage all of their investments. So if they have some money with a pension fund, they've got some money in some other retirement account, and then they have their active trading portfolio. That is another thing we've actually seen is it's a lot more of a diversified need. It's not just everyone comes and fits into a nice bucket. So being able to develop the tools for that is going to be a big challenge for us because people want to do things in mobile. It's just the medium we're going to have to learn to deal with, and I see that continuing here moving forward.
And how does that play out in a pension fund environment?
Yeah, I would add that over the next 10 years and even now, risk management is at the forefront of our investing, especially with the environment that we're in now. And a lot of the products, be it from Bloomberg or others, we're looking at to really just analyze the data. I don't think the fire hydrant of data is going to turn off. We're going to consistently be able to research and analyze and really to make really good decisions on the strategies that we are investing in across the portfolio.
And Mel?
Sure, I think that, in terms of technology, one of the things that we're going to see, and we've talked about the investment piece, but I think the interaction piece is going to change too. So at the end of the day, what we're learning is that investors want to talk to other investors. And so what you'll start seeing is technologies that enable that to happen. So a lot of the things that advisory firms are looking at now is how do we move the conversations that are happening on TikTok, on Clubhouse, on Facebook forums, how do we bring them in-house? and allow investors to talk to one another and also add our own views to that. So we are trial ballooning some products that have been, and actually in Asia, we tested a community-based platform that's done incredibly well for having investors talk to other investors and community building around particular topics such as ESG investing or philanthropy or even art. And we think that that's going to be the wave of the future and how technology will change